One year, Micron's memory chips were the scarcest thing in the AI economy, and the stock blew past $1 trillion. The next, it dropped more than 20% from its high, not because demand vanished, but because rivals promised a flood of new supply. So which is it? A rare entry point or the first crack in a peak? At roughly 7 times forward earnings, this looks absurdly cheap for a company sitting at the heart of the artificial intelligence build-out. But memory has broken the hearts of cheap-looking buyers before. The whole question is whether these earnings are a permanent plateau or the top of a cycle wearing a disguise. By the end, you'll understand exactly what Micron sells, why its profits swing more violently than almost any large company you can name, how management is betting its cash on high-bandwidth memory, and where a careful fair value estimate lands against today's price. The numbers do the arguing. Micron makes the memory that digital life runs on. The fast-working memory inside servers, phones and laptops, and the flash storage that holds your data when the power is off. It's one of only 3 companies on Earth that can build these chips at the leading edge. The concentration is stark. Of $37.4 billion in revenue last year, DRAM alone brought in $28.6 billion, more than 3/4 of everything. NAND flash made up the rest, about $8.5 billion. There is no third leg to stand on. Inside that DRAM number sits the product that changed the story: high-bandwidth memory, the stacked chips that feed AI accelerators. It is scarce, it commands premium pricing, and only 3 suppliers can make it. For a business built on commodities, that is a rare taste of genuine pricing power. Everything else, the split into compute, mobile, storage, and automotive, is mostly cosmetic. It is the same wafer of memory sold into different sockets. When prices fall, they fall everywhere at once. So Micron's fortunes ride on the price of 2 commodities, and one of them dominates. This business does not grow so much as it breathes in and out. Revenue was $27.7 billion in fiscal 21, $30.8 billion the next year, then collapsed to $15.5 billion in 23, cut nearly in half before rebounding to $37.4 billion last year. Earnings swing even harder because the cost base barely moves. Diluted earnings per share ran from $5.14 up to $7.74, then crashed to a loss of $5.34 in the downturn, before climbing back to $7.59 last year. That is the whole cycle in one line. Cycle. The margins explain the violence. Gross margin peaked above 45%, then went negative, minus 9.1%. In the trough, meaning Micron sold memory for less than it cost to make. Operating margin swung from plus 31 to minus 37. Fixed costs turned small price moves into enormous earnings moves. Returns on capital tell the same uncomfortable truth. Return on invested capital read 11%, 15%, then negative 10%, barely positive, and 12% last year. Return on equity followed the identical arc. At best, this company earns roughly its cost of capital at the very top and destroys it at the bottom. For a cyclical, the balance sheet is the shock absorber, and here it is genuinely strong. Net debt at year-end was just $5.6 billion against earnings before interest, tax, depreciation, and amortization of $18.5 billion. Net leverage of 0.3 of 1 time. That is what lets it survive downturns that would sink a leveraged rival. Where the model gets harder to love is cash. Operating cash flow was a healthy $17.5 billion last year, but free cash flow after the fabs are fed was just $1.7 billion. Look across 5 years and it is barely positive, with a brutal negative $6 billion in the trough. The reason free cash stays thin is one enormous line: capital expenditure. Micron poured $15.9 billion into plants and equipment last year, roughly 90% of operating cash flow and over 40% of revenue. This is not optional. It is the price of staying at the technology frontier. The dividend is small but sound. Micron started paying in fiscal 22 and has nudged it higher, from about 41 cents a share to roughly 47 cents last year. It absorbs only 6% of earnings, so it is easily covered and would survive a downturn comfortably. Buybacks tell the more revealing story. At the last peak, Micron repurchased $2.4 billion of stock. Since then, almost nothing, as cash was redirected to capacity. The result is a diluted share count that has actually drifted up, from about 1.09 billion shares in the trough to 1.13 billion. Put it together and management's record is mixed. Disciplined on debt, admirably willing to invest through the trough when rivals freeze, but the return on all that spending has historically only just cleared the cost of capital. Today's building spree is a high-stakes wager, not a proven machine. The competitive edge is real but narrow. Building leading-edge memory needs tens of billions in fabs and process knowledge only 3 companies possess. That 3-firm structure is far healthier than memory's fragmented past. It is why margins can touch 40% when the cycle runs hot. High-bandwidth memory narrows the field even further. It is hard to make, tightly qualified into customers' AI systems, and in short supply, something close to a real switching cost, which commodity memory never had. If that scarcity holds, the Moat genuinely deserves an upgrade. But the numbers do not yet crown a durable moat. A wide moat shows up as high, steady returns. And Micron's read 11, 15, -10, 1, and 12. A business with true pricing power does not sell below cost in a slump. Micron did exactly that, and recently. The rating stays narrow. Still ahead, where a careful fair value estimate lands and the single risk that could break the whole case. To the backdrop first. AI infrastructure spending is the dominant tailwind, with one widely cited forecast putting AI-related outlays near $527 billion in 2026, and memory is a direct beneficiary. This trades like a leveraged bet on the AI story. Its beta is 2.14, meaning it amplifies every swing in market mood. So in a risk-off tape, Micron falls faster than almost anything in the index. Elevated interest rates only sharpen that sensitivity. The sector sits in the late innings of an unusually steep upcycle, and the signals are turning ambiguous. Micron posted record results with capacity described as effectively booked through the year. Yet the stock still fell hard as commentary pivoted from scarcity to the risk of oversupply. That mood is written into the price. The stock sits about 21% below its high, near the top of a 52-week range that runs from roughly $103 to over $1,200. Still elevated after an enormous run, but with the first real doubt now priced in. The competitive picture darkened further. A class action suit filed in late June accuses Micron, Samsung and SK Hynix of coordinating to restrict DRAM supply and inflate prices. It is early, any real liability is years away. So for now it is a sentiment weight, not an earnings hit. Micron's answer to the capacity race is to join it. In July, it broke ground on a $9.3 billion high-bandwidth memory plant in Hiroshima, backed by Japanese state support and targeting a 2028 ramp. Everyone is spending, which is precisely what worries the market. The catalysts that matter now are concrete. The next earnings print and guidance, the path of DRAM contract pricing into late 2026, and any hard data on how fast the new capacity actually lands. Analyst opinion is openly split, with targets stretching up toward $1,550. Valuing this means holding 2 facts together. On last year's earnings, the stock trades near 130 times. A number that means nothing except that the market is pricing something entirely different from the past. That something is the forward earnings the AI cycle is expected to deliver. Wall Street's forecasts are staggering. Consensus sees revenue tripling to about $129 billion this fiscal year, then $248 billion next, with earnings per share leaping from $7.59 to $73 and past $150 the year after. At today's price, that is under 7 times those out-year numbers. 3 lenses bracket fair value. A discounted cash flow model struggles most because free cash flow has been chronically eaten by capital spending. And a through-cycle view, averaging profits including the loss year, implies value in the hundreds, not near 1,000. Both warn against paying for the peak. Weighting the forward earnings lens most heavily, then the through-cycle discipline, then the cash flow model, blends to a fair value range of roughly $525 to $955 a share. Against today's $985, the stock sits at or just above the very top of that range. The dominant risk is the one the market just woke up to, DRAM oversupply. It would show up first in falling selling prices, then in gross margin. And with this operating leverage, the damage compounds fast. The evidence to watch is contract pricing rolling over. A couple of quarters of that resets the entire thesis. The second risk strikes at the core of the story, that high-bandwidth memory proves less special than the bulls hope. If SK Hynix and Samsung close the technology gap, Micron's premium erodes toward commodity economics. Watch for its HBM revenue stalling and that margin premium narrowing against standard chips. The antitrust overhang is lower probability but persistent, and awkwardly it constrains the very supply discipline the bull case leans on. Yet the upside is just as real. If AI demand keeps outrunning supply, 7 times earnings is genuinely cheap, and the binding long-term contracts give that case near-term ballast. So, which is it? Bargain or peak in disguise? On the evidence, Micron looks expensive to fully valued rather than cheap. Priced at or above a fair value range that already assumes the boom is largely durable. 7 times forward earnings is only cheap if these peak profits become a permanent plateau, and the 5-year record warns against that bet. The single biggest danger is blunt. The roughly $2 trillion of Korean capacity breaking DRAM pricing before AI demand can absorb it. The exact mechanism that has ended every prior memory cycle. If that happens, the through-cycle math, not the supercycle math, takes back control of the share price. This is an educational analysis, not investment advice. Every figure here comes from public filings and consensus data that can change. Do your own research and weigh your own risk tolerance carefully before making any decision. If breaking a company down to the numbers like this is useful to you, subscribe. It genuinely helps. And tell us in the comments which stock we should put under the microscope next. Thank you very much for watching, and we'll see you next time.